Here we are, on the last trading day of the year. This year was completely different than what was expected. We were expecting the US to enter a recession, but the US printed around 5% growth in the Q3. We were expecting the Chinese post-COVID reopening to boost Chinese growth and fuel global inflation, but a year after the end of China's zero-COVID measures, China is suffocating due to an unexpected deflation and worsening property crisis. We were expecting last year's negative correlation between stocks and bonds to reverse, as recession would boost bond appetite but batter stocks. None happened. The biggest takeaway of this year is the birth of ChatGPT, which propelled AI right into the middle of our lives. Nasdaq 100 stocks closed the year at an ATH, Nvidia, which was the biggest winner of this year's AI rally, dwarfed everything that compared to it. Nvidia shares gained more than 350% this year. That's more than twice the performance of Bitcoin, which also had a good year, mind you. The million-dollar question is what will happen next year. Of course, we don't know, nobody knows, and our crystal balls completely missed the AI rally that marked 2023, yet the general expectation is a cool down in the technology rally. And a rebalancing between the big tech stocks and the S&P 493 on narrowing profit led for the Magnificent Seven compared to the rest of the index in 2024. The other thing is, the S&P 500's direction next year is unclear, as the Federal Reserve is expected to start chopping the interest rates, with the first rate cut expected to happen as early as much with more than 85% probability. So what will the Fed cuts mean for the S&P 500? Looking at what happened in the past, the S&P 500 typically rises after the first rate cut, but the sustainability of the gains will depend on the underlying economic fundamentals. Lower rates are good for the S&P 500 valuations, except when the economy enters recession within the next 12 months. So that backs the idea that I have been trying to convey here since weeks. Lower US yields will be supportive of the S&P 500 valuations as long as the economy remains strong, and earnings expectations hold up. For now, they do. The S&P 500 earnings will certainly end a bit better than flat this year, and the EPS is expected to rise by more than 10% next year. The Magnificent Seven are expected to post around 22% EPS growth next year. But note that, these expectations are mostly priced in, so yes, there will still be a hangover and a correction period after a relentless 2-month rally triggered a broad-based risk euphoria among investors. The S&P 500 is about to print its 9th consecutive week of gains, which would be its longest winning streak in 20 years.